Hey fam, welcome back to another handle trade video. So in today's video we'll be looking at a very interesting topic, of course, which is the spread. Right, what are spreads? You can see on the headline or on the title, it basically be looking at what a spread is and how it affects our trades. Right, how it affects our trades. Okay, so let's jump into the video. Okay, so without further ado, let's jump into it. So what is a spread? Okay, so a spread is basically the difference between the bidding price as well as your asking price. Okay, so you might be wondering what is a bidding price and the asking price. Okay, let me make it simple for you. So basically a bidding price is a price that your broker will fill you in when you are selling, right? So it's basically the price that your broker will fill you in when you are selling, and then the ask price is basically the price that the broker or your broker will fill you in when you want to buy. Okay, so it's basically the vice versa, which is that bid is basically the selling and then ask is your buying. Okay, so just think about this, like when you go to a car auction, when they auction cars, there is an opening bid, right? When they are auctioning a car, right, there's an opening bid. So an opening bid is basically, it means that the minimum price that the car is worth, or rather the minimum price that the company, or rather let's say at We Buy Cars, when you go to a car auction, then they'll give you the minimum price of the car. Let's say they're bidding the price at 150,000 rand, so that's the bidding price, that's what they are selling the price for, right? Or at the minimum price, of course. So here is the same thing. The bidding is basically the selling, the price whereby your broker will fill you in when you are selling, right? I hope that makes sense. And then this is a visual representation, or rather a picture of how it looks like when you're using a PC or a laptop. This is a screenshot of when you're using a laptop. So basically the bidding price is basically the price where you are selling at, like you can see here on this. Let me see, where's my cursor? Okay, so you can see that here on this point here, this is my bidding price. It means it's basically my selling price, or where the price, or rather where the broker will fill me in when I'm taking a sell position. And then the ask price, as you can see that here on the right hand side, that's basically where the broker will fill me in when I'm taking buy position, or rather when I'm looking to go long. Okay, and then this is a phone visual representation of how it looks like on an MT5 or an MT4, right? So so this is a visual representation. Okay, now let's look at an example of how to calculate a spread and how they basically affect our trade, right? So now we have identified, rather we have defined what a spread is. We say the spread is the difference, we didn't define it, but we did talk about the selling and bidding price. So I hope that makes sense, right? I hope that that makes sense, what a bid and what a ask is. Okay, so now let's define a spread. We basically did define the spread. We said the spread is a difference between the bidding price as well as your asking price, right? So on your phone, when you open your MT5, so you can see that you have this is USD JPY. So you can see that here on this point here you have your selling price. So when you press that sell button, the market will fill you in at that price then, and then when you open, or rather you open a buy position or long position, then the market, or rather the broker, will fill you in at that position. Now where does the spread go into this? So a spread is basically the difference between the two. So it's basically the difference between where is this now? Hold on, I can't. Okay, so basically your spread is basically the difference between your ask, right? Your ask as well as your bidding price. Okay, so as you can see, the spread is equal to your asking price minus your bidding price. Okay, so in this example you can see that your asking price is 157.839, right? And then your bidding price or your selling price is 157.812. So if you subtract the two, then we get 0.027, which is 2.7 pips, right? So if you did watch our prior video on introduction to Forex, we did look at how to calculate the spread, rather the pips for USD JPY and non-USD JPY pairs. So yeah, this is how you calculate the pips. So it's basically the 2 pips, 2 pips after the decimal, that's a unit, and then going to the left it increase, you get tens, 100, 1000, 10,000s. So in this case you can see if you subtract the 2, then you will get 2.7 pips. So if you don't know how you got 2.7 pips, then I recommend you watch our prior video on we did explain what a pip is and how to calculate a pip, right? So a spread is basically the difference between the two. So if you subtract the 2, you will get 0.027, which is 27 points, yes, which is 2.7 pips. Okay, hope that makes sense. So now what does the 2.7 pips tells us, right? So that 2.7 pips, it means that if you wanted to buy USD JPY, of course at the time of recording this the price was at 157.812. so that means that if you wanted to buy USD JPY, right, so if you wanted to buy USD JPY, let's say that for instance the exchange rate or the current price is running on 157.812. let's say you wanted to buy USD JPY, so it will mean that your broker, instead of your broker filling you at that exact price at 157, then it will fill you in at 157.812, 2 pips higher than that, right? So it will fill you 2 pips higher than 157.812. Hope that makes sense. And if it doesn't make sense, then excuse me, I'll explain it again, right? So listen to this, right? So if the price or the market is running on 157.182, and then you anticipating a buy, so are you anticipating a buy, and then when you press that buy button, what will happen is that the price will not fill you in at that exact price, right? It will not fill you in at 157.182, but it will rather fill you in 2.7 pips higher than the actual price, rather than where the market is at, right? Let me just do a let me just do this here. Okay, so I can't even see my cursor. I don't goodness. Okay, so I hope that you guys can see it. So okay, yeah, there you go. So I have to press, I'm using a digital pen, and okay, yeah, so you have to press, yep. Okay, so let's say that the price is pushing like that, right? And then you wanted to buy at this point here, right? I hope you can see this this here. Hope you can see this here. Okay, so let's say you wanted, the price is moving in this in an uptrend, and you actually wanted to buy here at this point, right? So what will happen is that instead of your broker where's that case? Okay, instead of your broker filling you at when you buy, right, instead of your broker filling you at this point here, instead of your broker filling your order at this point here, it will fill you in 2.7 pips higher. That means that if you are to buy here, then your order is going to be filled in right there, to be filled in 2.7 pips higher, right? And hence that means that you will be running on negative immediately when you open a position, right? Immediately when you open a position, you'll be running on negative. So this is not because your broker is a scam or anything like that. It's just that it's the way of the broker protecting themselves, right? They're not protecting themselves, but it's just a commission. It's basically you paying the broker for buying and or selling in that case, right? So because nothing is free, you have to pay the broker for buying and selling. That means that you are paying the broker that 2.7 pips, right? That's what your broker is taking from you for buying, right? So yeah, that is that's how it is. And then of course in this case, if you look at it like that, then the 2.7 pips, if you can see here, where's my, okay, so here you can see that the price was running here. Let's say if you wanted to buy, then your broker was going to fill you in at that point there. So that means that in order for you to be in profit or to be in blue, then the market has to actually be above this red line here, right? As long as the market is still below this red line here, you are still on negative. Okay, so that's the spread, and that's how it typically affects your positions, right? It typically affects your entries and your positions, of course. Okay, so and the spread changes all the time, right? It changes all the time, right, based on the volatility, right? Of course, when there's higher volatility, then of course there'll be a higher spread, right? Again, it depends on the type of broker that you're using. When there's higher volatility, there'll be higher spread. Lower volatility, then there's lower spread. And then when like we are trading, like the like currencies, like your exotic currencies, the developing currencies, then the spread might be higher than the major one, like your USD JPY. You see USD JPY, your Nasdaq, your Euro USD, your GBP USD, and so on and so forth, right? So I'll rather recommend you trade we did talk about this, right? We did talk about the types of currencies. So I'd rather you focus on one currency pair or two, like USD JPY, GBP USD, Euro USD, rather than trading these developing countries like USD ZAR, like Brazil and stuff like that, right? So yeah, but then it's all up to you, of course. This is not any financial advice or anything like that. This is just for this video is basically meant for educational purposes, not in any way financial advice, right? So don't come to me and be like, yeah, this dude told us to do that and that. So this is not financial advice. Please trade trade carefully there. The market is too risky. And yeah, so yeah, that's a spread, right? So let's see how it basically affects our stop losses and take profits. Okay, so let's look at this, right? So what happened when the price, let's say we are still pushing in higher highs and high lows, and what happens is you buy on a higher low. Let's say you buy on the high low, and what happened is that let's say you find a demand zone, right? So you're trading on a demand zone or your support area. So let's say you got an entry on a demand zone, and you place your stop loss below the previous high low, right? So this is where your stop loss is sitting at. So now what happens when the price, instead of the price respecting your demand zone or the zone that you've highlighted, instead of it respecting it, it pulls a little bit down, and what happens when the price, the exchange rate is at, and the stop loss, if the difference between your stop loss, if the difference between your stop loss and the actual price is 2.7, where's this cursor? This digital thing is getting my nerve right now. So okay, there you go. So what happens, okay, so my bad. Okay, there you go. So what happens when your okay, the question is, what happens when the price goes a little bit down, it retraces a little bit down, and then it's 2.7 pips away from taking your stop loss, given that the spread is 2.7, right? So if the spread is 2.7 and the if the spread is 2.7 and the difference between your stop loss and where the price is currently is 2.7, then you will be taken out. You'll be taken out of that trade, right, because of the spread, right? I hope that makes sense. Yeah, so that's basically the spread. That's how it affects our trade. There's nothing positive about it. It's all negative. Like, I hate spreads, like for real, I hate spread. So what happens, like when you trade on a demand zone, when you find an entry on a demand zone and then you take a buy, like you take a buy on a demand zone, and then all of a sudden the price or your broker fills you in somewhere there, right? So your broker fills you in somewhere there, but you bought somewhere here, and then all of a sudden fills you in somewhere there, and then all of a sudden you're losing more than you are planning to lose, right? You are losing more than you're planning to lose. So that means that you have to now reduce your stop loss to an area, to a certain area. If you are you are using a calculated stop loss, then you have to reduce your stop loss. Then yeah, that's a negative aspect. There's nothing positive about a spread. So a spread is basically negative stuff, unlike what we've discussed in a prior video, like the leverage and the lot sizes. Those are positive stuff, right? Because they make us money. But in this case, the spread is basically, it's something else, right? It's just weird, right? I don't know. So yeah, that's the spread, guys. So please pay attention to this. A spread is the difference between your bidding and your, or rather your asking and your bidding price. And how it affects your position is that if, like for instance, we have discussed, let's say 2.7 pips was the spread. So if you put your stop loss there, and then the price is basically at this point in the let's say you bought here, this was your buying position, and this is where the price is sitting at currently, and then your stop loss is there. This is your SL, your stop loss. So if the difference between your your stop loss, which is this point here, if the difference between the stop loss and the way the price is 2.7, then your profit, or rather your position, will be closed automatically without the market, or rather the price, reaching the stop loss, the exact stop loss, right? So that's a negative part of it, right? That's disgusting, right? It's getting my nerve, this spread stuff, right? So make sure that whenever you're trading, you look at your spread, enter the market when the spread has reduced, or when it has cooled down, or rather when there's, I mean, it depends. If you want that volatility, then of course it will come with disadvantages. But then yeah, just look at the spreads and then just see whether how it will affect your trade, and use a calculated stop loss, right? Make sure that you use a calculated stop loss based on the spreads. So now that you understand how the spread will affect your stop loss, then you use that with your advantage, right? You also move your stop loss 2.7 so that you do not lose more money than you are willing to lose. And then of course you increase your take profit as well, because it can, whatever happens with the stop loss, it also happens with your take profit. The market will not hit your take profit exactly, but will hit, let's say the market was pushing like that, and then let's say this is you are buying on the higher low, and then this here is your TP or your take profit. So if your TP and the price is 2.7 pips, then the price the market will take you out at, the market will give you you give you a profit at where the price is sitting. Let's say you are aiming for $10 here, so where your take profit was $10 and the price is sitting on, this is an example, let's say the price is sitting on $7. So what happens is that the price will give you, or rather your broker will give you $7, and they will take that $3, right? So that they will take that $3 that is sitting there, and you will get the $7. So that's the negative effect. Rather, there's nothing good about the spread. It's just commission, debts. You're paying off debts, just like debts, right? So you're just paying and paying and paying. And yeah, that's the spread. And yeah, I hope that this video it gave you some some information, or something you didn't know about. And yeah, if you found value in this video here, please do me a favor and hit that like button, hit the subscribe button, notification bell, and get notified whenever I post a new video. Remember, it's 2025. I'll be posting more video. Most people want to make money this year. This year has to be the year, guys. It has to be the year. So make sure that you do not run into scam. You do not pay for any course, because there are courses here. There are courses on YouTube that are for free. Just do your research, sit down with it, just do your research, and yeah, you'll get your course. You'll get whatever you want on YouTube, right? So everything that you need is on YouTube. And funny enough, I also learned this thing on YouTube. I never had the funds, or rather I did have the funds. It's just that I don't know how I knew that people were scammers, but then people are scammers out there. You'll just pay them $100 for them to teach you what's on YouTube, right? You're paying $100 for something that's on YouTube, or something that you can learn your own, right? So this thing is for free, like free stuff. The information is free on YouTube. Go to YouTube, find the information. I'm not saying you have to like subscribe to mine. There are a lot of people that are doing this on YouTube, and yeah, you basically have to find which one is legit for you, or which one will work for you, and then you subscribe to the channel. So whenever the person posts something like luxurious stuff, like them hiring a car, or rather showing off the cars and stuff like that, then you should know that's definitely a scam. I'm not going to say anything about it, but then yeah, I'll just end the video here. Hope that you guys you enjoyed it. December, and now it's 2025. It's a new year, and we're trying to make money. We're trying to make that money, right? So yeah, I'll catch you on another one. This is it for me, signing out. Cool.